Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday? All right, everybody. So welcome to this presentation. So this is the money multiplier, method. So before we get into the content in the presentation, I have a question I want to ask everybody here. Now, those of you who have seen this question before, don't cheat, right? So it's a question. So what in life should you control? Or what in life are three things that you want to control? So as I said, this is interactive. Go ahead and use that chat box up there if you guys want. But think about three things generally in life that we would want to control or should control. Now, there's two very common answers that I get from everybody when I ask this question. Okay, so the first one is money, right? We all think we should control money because if we don't control our money, somebody else is going to control it for us, right? Yeah, Chris, yourself, exactly. Hey, Chris, how you doing, man? So yeah, so money is something we want to control. But if you look at our money habits, which by the way is what we're taught, we actually give control away of our money to everybody else. So you give it to Wall Street, corporate America, 401ks as an example, the IRS, credit companies, banks. We give money away instead of controlling it ourselves. The second thing that we all want to control is time, right? Time is that one thing that once it goes away, it never comes back. Unlike money, by the way. But time is that one thing that is very valuable. In fact, this is an epiphany I had early on in my journey. I realized that I was trading time for money. Now we all do that. I'm doing it right now, by the way, in what I do and other things in my businesses. But we give our time away in exchange for money. We trade time for money. But why is that? It's because somebody else is going to make more money off of our time than they're going to pay us for our time. So they value our time almost more than we do because they're making more money off of it than they're paying us. So that's kind of a strange epiphany for me when I realized that. But before you can control time and money, and by the way, time is the one thing I want to control above all else. Money's fine, but time is my big thing. So what is the one thing we got to control first? Okay, Chris said yourself, your mindset. So you've got to control your mindset, your knowledge, because that's where everything starts. You can't control money, you can't control time if you don't have the right mindset. Hey, Kathleen, how you doing? So yeah, so you got to control that mindset first. So that's what we're going to be talking about in this presentation. Part of it is that mindset. How do we change the way we think about money? Now, I want to share a quote that we like to talk about here at the Money Multiplier and BYOB, and it's by Will Rogers, and it says, the problem in America isn't so much what people don't know, it's what people think they know that just isn't so, or not true. Okay. Hey, Anthony, how you doing, man? So yeah, so as we go through this presentation, the one thing I'm going to ask you is to keep an open mind. Now, like Anthony and Kathleen and a lot of the other people on here are existing clients. I work with some of the people personally, and a lot of their epiphanies came when their mindset shifted around the money and around infinite banking. So keep an open mind, all right? Now, I want you to think about this. This is kind of a weird kind of statistic out there. So if you grabbed 100 18-year-old kids, I call them kids, right? And put them into a room and you ask every single one of these kids, hey, where will you be when you're at the age of retirement? So let's say age 65. Do you think they're going to say, oh, I'm going to be poor and broke? No, of course not, right? They're going to say, I'm going to be a millionaire, a billionaire, very wildly successful, all that kind of stuff. But here's the reality. Out of those 100 people, only 5% will be financially secure at the age of retirement. Not wealthy, not rich, just financially secure. 5%. of the 100 people. And by the way, this comes from the Social Security Administration, right? They say that 5 out of 100 people will be financially secure at the age of retirement, which is crazy that we live in like North America, Canada, Canada and the US, very successful countries, very wealthy countries, lots of opportunities, yet only 5 people will be financially secure. So let me ask you all a question here. Who wants to be one of the 5%? Give me a yes in the chat box if you want to be one of the 5%, because if you're here on this presentation, I believe that you want to be one of those 5%, right? That's why we're here. That's why we're learning. That's why we're gaining this knowledge, right? So for those of you that are new to this presentation, I mean, yeah, there you go. Yeah, Chris is on the way to being a trillionaire. There we go. Exactly. Kathleen, David. Yeah, exactly. So we want to be one of those 5. Now, what we're going to be talking about in this presentation, this strategy is one of the ways that a lot of wealthy families actually maintain and keep and grow their wealth. So, as I said, keep an open mind. Now, real quick, who am I? If we've never met, you haven't heard me before. So, I'll say Brian Faust, but I went to school, did that traditional path, right? That's my degree from Washington State University in Washington State, of course, in construction management and business. I have not seen that degree in about 10 years. I think it's somewhere in my boxes. I don't know, but I haven't used it in a long time. But I went to college, but I call that the hard way. Okay. I was raised lower class. My parents, were still together and, all the kind of stuff, great family, but I was raised lower class, didn't really have money growing up at all. I remember actually in the mornings having to start the wood fireplace to get the house warm in the wintertime. But I went down that traditional path, which is what I was taught to do, right? And I got that job, got the 401k, all that kind of stuff. I had the house, I had the growing family, I had that the white picket fence kind of lifestyle, so to speak. And I was told that I was following the American dream. I had the American dream. And if you've ever talked to me one-on-one, I'll tell you where the American dream came from, where that saying came from back in the 50s, by the way. Anyways, but I felt like the American nightmare to me. I was drowning in debt. I didn't know what was going on. I was not happy with my job, what I was doing. And I was at a doctor's office. A lot of you heard me tell the story, but I was at a doctor's office and remember how they used to, before the cell phones, right? They'd have all those magazines out on the table. And I grabbed one. It was a financial magazine. It said that it said the millionaires in the world know their net worth, but the average person doesn't. And I realized, oh, I don't know my net worth. And that was it right there. After 10 years of corporate America, I had a negative net worth and it was just getting worse. Kind of crazy. So I kind of like, what the heck is going on? It doesn't make any sense. If I keep doing what I'm doing, I'm not going to be financially secure. I'll never be able to retire. And really quickly, so one thing that kind of really kicked me into gear was my grandfather. So he was my idol. He was a very well known in the community as a teacher and coach at the local high school, and I loved him, and he was great. And then he worked really hard though into his 60s because he wanted to retire and then go travel around the West Coast with his wife, my grandmother, and go to sporting events. And that's what he did. So he worked up until his 60s, bought a motorhome, and for about a year and a half they did that. But then he got really sick. He got leukemia, he got Parkinson's, kidney failure, all these things, and ended up passing away. And the last 3 years of his life, he couldn't even leave his house. And he told me, he said, hey, go live your life now. Don't wait. And that was kind of one of the last things he kind of told me before he couldn't talk anymore. And so that's, kind of one of the things that I took to heart, and that's what I started doing. And so I left my career. I got into real estate and started doing e-commerce. I got involved with a lot of Robert Kiyosaki advisors and started my own businesses. So this is one of my businesses. This is actually in the middle of COVID. It was an Inc. 5000 business, 7-figure business. And this business has to do with the concept we're going to be talking about here today, because that's when I started really leaning into this strategy. And it's done a lot of stuff for me and allowed me to live a pretty cool life in the last, I would say 7 years of my life. I like to travel. I like to have experiences. So if you guys can't tell, I like cars. So like the Cougar, that's my current car right there. But I like to have experiences. So time is my big thing I like to control. But this journey has led me to actually talking about this concept and this strategy to a lot of people. And I've helped a lot of people do this, helped them learn how it works. This is actually me at a high-level mastermind many years ago teaching this concept. And there was actually some billionaires in the room that actually came up to me and said, what you're talking about is what we do. So it's kind of cool to have that validation. But yeah, so that's what it's led me to do. All right. So one thing I want you to understand about this concept is that it's not a new concept. It's been around for well over 100 years. It's not new. And there's actually people that talk about it. But if you don't know what this is, you might not know what they're talking about. So Robert Kiyosaki. So I work with his, I've worked with a lot of his advisors, so I know some of them personally. And one of them, by the way, was my mentor for this concept. But in his book, Second Chance, he talks about this concept. Tony Robbins, I've been to, I think, 2 or 3 of his big events. And he talks about it in his book, Money Master the Game, which I recommend these books, by the way. Then, of course, you've got Nelson Nash, the one that popularized the concept of infinite banking. And that's a great book right there, written about, I think, 20, 30 years ago. I definitely recommend that one. And then, of course, one of my mentors and friends, Brent Kessler and Chris Naugle. So they wrote the book, Mapping Out the Millionaire Mystery. And then, of course, Chris wrote the book, The Private Money Guide, which talks about how to do this. So what I'd recommend, by the way, is to get these books, but the bottom 2, I have those on PDF. And so if you want to get those ones, they're free. Just send me an email. I'll put my email address here in the chat box in a little bit. I'll email you those 2 bottom ones and some other resources. There's no cost like that for the PDF version of those. Okay. Christian says, you look different. I've seen you in an older video with Ted Thomas. Yeah, Ted. Yeah. Probably a little more gray right now. Okay. So think about this. So who has used this concept throughout history? Okay. So there are some documented cases, quite a few though, but here's some people that have used this throughout history. So Jim Harbaugh, so he was actually paid. He was one of the highest paid college coaches at that time, and he was paid through cash value policies, like we're going to be talking about. So he was paid that way by the college. This guy, now you might not remember who he is, Joe Biden. So Mr. Joe Biden, he has, I think, 6 of these policies that he actually disclosed years ago, and so he has a lot of policies on him and his family. So. And I just saw a thing that he just found out he had cancer, so that's not good. But anyways, yeah, so he has 6 of these things. Walt Disney. So Walt Disney, this is way back in the early 1900s. Yeah, I think is when it was. He couldn't get a loan to start Disneyland. Okay, so he actually used this concept, which existed back then, okay, to start Disneyland. So without this concept, we might not have Disneyland as we know it today. Ray Kroc. So Ray Kroc, when he took over, or I guess that's how I look at it, took over McDonald's from the McDonald's brothers, he used this concept to fund the growth of McDonald's for the first 8 years. So without this concept, we might not have McDonald's as we know it. Pampered Chefs, he used this to start the Pampered Chef, which has turned into a billion-dollar business, and Warren Buffett, I think, took it over. And then a lot of wealthy families. So the JPs, the Morgans, Chases, Vanderbilts, the Rockefellers. Rockefellers, by the way, have been doing this since the 80s, a long time. But here's the thing. Anybody can pretty much do this if you understand how it works. All right, so now what will infinite banking do? So this is really key to understand this. What will it do for you? So a couple of things. So one is it creates guaranteed generational wealth day one. By the way, tax-free. I need to add the tax-free thing in there. But it's guaranteed. So it's not like year 30, it's day one, you have guaranteed tax-free generational wealth. If you understand how this works, eventually you'll understand why wealthy families do this on every single family member when they're born. It's incredible. It allows your money to grow uninterrupted compounding for the rest of your life with guarantees. So uninterrupted compounding. So compounding interest is amazing, but uninterrupted, meaning it does not stop no matter what you do. It grows for the rest of your life, can really build wealth. It takes control. So remember we talked about control at the beginning of the presentation, but this takes control away from the big banks, away from corporate America, from Wall Street, from even the IRS, and puts that control into your hands. If you want to build wealth or have a different outcome in your life, control. You have to maintain control of your time, your money, and of course, your mindset. It protects your money from lawsuits, from bankruptcies, from divorces in most states, by the way, not all states. If you're in California, sorry, it is California. Washington, even worse. But for most states, it provides protection so that it's a secured asset. Now, very important. It allows you to be the bank for the things that you may use a bank for traditionally. So think of things like real estate investing, buying cars, college, paying off debt, by the way, retirement, investments, all these things. But here's the cool thing. You can do all of those things, investing, college, whatever, but you still have all of the benefits above as well. It's not one or the other. It's all at the exact same time. Okay. So give me a 1. So by the way, I'm going to call you out. Give me a 1, give me a yes in the chat box if that's something you want to have in life. To have all of these things, not just one, by the way, but all of them working for you at the same time. That makes sense? Yeah. Christian, of course, says yes. Hey, Jeremy, how you doing? Yep. Yeah. And so that's what this can do. So, all right. So as I said, ask questions, use that chat box, use the Q&A box. Feel free to ask questions, okay, as we go through this. All right, now really quickly, what I want to illustrate here is the mindset side of things. So there's this thing called the backwards bicycle, and you can go Google the video. It's hilarious to watch it, but do it after the presentation. But it's called the backwards bicycle. And on this one, like on a traditional bicycle, right? You get on, you turn your handlebar to the left, you go left, okay? When you were a kid, you learned how to ride a bicycle, you hop on one, it's pretty easy to pick it back up again. But the backwards bicycle, it's a bit different. When you get on that backwards bicycle, you turn your handlebars to the left, the wheel goes to the right. And the video, this guy is falling over trying to get on this bike. He cannot ride it. But it takes him some time, but eventually, guess what happens? He learns how to ride the backwards bicycle. Now, what happens though when he gets back onto the regular bicycle? He can't ride the regular bicycle anymore because he changed his way of riding, his mindset, right? And so money's the same way, okay? When you learn a new way about money and how it really works, it's hard to go back to the original way of drowning in debt, using credit cards to live, right? And so, as I said, keep an open mind as we go through this, but really funny video that kind of illustrates the mindset. When you change it, what happens? You can change the direction you're going, all right? Okay. So real quick, the mysteries of money. Why aren't more people successful in life, financially speaking, mostly? So here are the things that can kill wealth. Keep these things in mind. So one is taxes. I don't mind paying taxes, but I'm a lot happier paying a lot less, by the way. Inflation, which is inflating of the money supply, is one of the big things. We call that the hidden tax. Volatility, so ups and downs of the markets, not having consistency in your returns. Interest, by the way, the average family pays like 18,000 or 20 some thousand in interest a year. And then of course, mindset, following the status quo, fear, okay, FOMO, fear of missing out, life in general. And then of course, what we're taught, those things can kill wealth, right? Okay, so quick things to keep in mind. So what is the definition of money as we go through the presentation? It's just a means of exchange. It doesn't matter if it's dollars, seashells, gold coins, doesn't really matter. Okay, what company uses compound interest? A lot of people will say, well, banks use compound. No, they don't. They charge you interest, but they don't use compound interest themselves. They really don't. Okay. So what they do with money is put it into motion. And we're going to talk about that. Are your dollars worth more today or in the future? So think about a dollar bill, what you can buy today in a candy store versus what you could have bought 20 years ago, what you could have bought in a candy store. It's a lot different. So your dollars are actually more powerful today than they are down the road. Okay. Do taxes go up or down over time? Kind of a joke question, right? They go up over time. Okay. So if taxes go up, let me ask you to think about this for this scenario. Let's say you're a farmer and you're going to go buy some seed, okay, some grain, and you're going to pay $5,000 for that. Okay. You're going to plant that seed, and then 6 months later down the road, you're going to harvest it for, like, let's say $50,000, $75,000, something like that. Would you rather pay taxes on the seed or the harvest? Now, most people will say the seed, right? That makes sense. Of course, yes, you want to pay taxes on the seed. But here's the thing. We don't do that with our money. So, like, would you wait to eat bread or drink milk? No, of course not. You'd use it today. But yet we put our money into these retirement policies like a 401k, and we don't get to use the money until down the road, but we're taxed down the road. So we're actually literally paying taxes on the harvest, not the seed. But intuitively, we know that it makes more sense to pay taxes on the seed and not the harvest. Because once again, taxes are going to go up over time. Okay. So what we want to do is use our good dollars today and down the road. We want to be able to put these things into work, because we're not going to buy, food and then store it for 5 years and then use it. We're going to use it as soon as we possibly can, right? Same with driving a car or buying a car. You're not going to buy a car, park it for 5 years, like a Honda Accord, something like that, and then drive it 5 years later. You're going to use it now. So that's what we want to do with our money. All right, real quick. So how does our money flow? So think about a typical transaction, a banking transaction. So buying a car. Most of us have bought a car either with cash or with a bank with bank financing. So let's look at how the money flows with this transaction. So let's just say that you have a bank over here and you have $25,000 in the bank, just cash sitting there and not earning you anything. And you're going to go take the cash out of the bank and go buy the car. But the banker says, well, hey, wait a second, Brian, stop here for a second. Before you go buy the car with cash, how about this? How about I give you 4% on your money that's in the bank? And I give you a loan of $25,000 at 6%, and we'll do it over 60 months. Equal payments, right? Okay, that's a typical transaction, but you're now getting 4% on your money, but you're paying 6% on $25,000. So what does that look like? How's the math work out? Does this make sense versus paying cash? Well, the monthly payment back to the car loan or the bank is going to be $483 per month. Future value of all those payments is $28,999. Okay, that's just simple math right there. But what happened to your $25,000 earning 4%? Remember, 4% is less than 6. Well, here's what happened. The future value of the money in the bank is $30,525, which means if you do the math on it, you made $1,526. Okay. That's because you're earning 4% on an increasing balance and you're paying 6% on a decreasing balance. Okay. So this is how it works. So it makes sense to do something like this if you can get your money working for you at 4%. Now, somebody might say, well, Brian, if I paid $25,000 for the car, I don't have any payments, yet in this scenario, I have payments. Good point. But let's say you used $25,000 and paid cash for the car. Okay, you have no cash. How did you get the cash in the first place? By saving money over time. So now let's say if in the cash example, you did cash, then you took $483 or something like that, and you paid it back into your savings account to replenish that cash. Same thing. The cash is the same, except in this example, you've actually made more money. Okay, so that's how it works when we look at this kind of transaction. So I just want to keep this in mind. Okay. All right. So here's the three things we're going to be covering here on the presentation. The first one is what is called the machine. So what is the machine? What is the thing that makes this concept work? Then we're going to talk about the marathon, because this is not a sprint. It's a marathon. Like the longer we do this, the more and more better it's going to get. So we're going to talk about that. Then, of course, everybody's favorite topic, the millionaire. How do you build wealth with infinite banking with this concept? Okay. All right. So let's dive into the machine. All right. So I like cars, sue me. So think of infinite banking like a car. Okay. It has wheels, tires, all these kind of things. It hopefully has a radio, windshield, blinkers, all the kind of stuff. But if that car has no engine, can it go down the road? Can it function? No, it can't. So what is the engine that makes infinite banking, the car, work? What's the engine? It is nothing more than a specially designed dividend-paying permanent whole life insurance policy from a mutual insurance company. Okay, that's what it is. It's nothing more than that. But once again, it's not off the shelf, specially designed policy that only a handful of people can really do for certain reasons. So we'll talk about that. But yeah, and there's only about maybe, I think, 6 to 7, maybe 8 questions, or sorry, no questions, mutual companies, not questions, mutual companies that can do infinite banking, by the way. And we work with about 5 of those companies. So yeah, so there you go. Okay, one last thing too. So if you're thinking like, well, why life insurance, Brian? I mean, I get it, but I mean, do people really use life insurance for this kind of stuff? So BOLI, bank-owned life insurance. So guess who the biggest buyer of these kinds of policies are? It's banks. So banks own more life insurance than they do their buildings and real estate combined. They own it on their bank presidents, bank CEOs, executives, all that kind of stuff. And guess who's the beneficiary? The bank. So do they know something that most people don't? Yes. So we're essentially bypassing the banks and doing what they're doing with our own money to a degree. So yeah, so there you go. Okay. So how does your money flow? So once again, as I said, can you make more money earning 4% while paying 6%? The answer is yes, you can. And we showed the math on that, right? So that's how it works. But once again, what's the bank doing though behind the scenes? Because this is a banking transaction, which we're going to show you how to replace it with your own banking system. But what does a bank do with your money? To understand if you want to be the bank, let's look at what they do with your cash. Okay. So let's say that you put, let's say $100,000 on deposit with a bank, and let's say they're going to pay you a generous 4%. Do they just sit there on that money? Of course not, because what is that money to them? It's a liability because they have to pay you 4% on that money, and it's your money that they're holding. Granted, you gave them control of it, but that money is a liability to them. So they're going to turn around and guess what? Put that money into motion. Maybe it's on a home refinance or a 7-year ARM, something like that at 7%. Now, what does the home seller, the seller do with the money that they get from you or the bank, by the way? Well, guess what? They put it right back into the bank again. What's the bank do? Same thing, puts it right back out. Maybe it's on a car loan. What's the car company do? Puts it back into the bank. What's the bank do? Puts it back out on a home remodel, maybe something like that. What's the contractor do? Puts it back into the bank. Maybe they lend it right back out on a debt consolidation loan. So what you can see here is what they're doing is they're keeping your money in motion. okay? Because they can do that. And so they might be paying you 4%, but guess what? They're going to make 500% more on your money than they're paying you. They're going to make like 20, 30% on your money. And by the way, is that a true thing? Absolutely. You can go look it up on BauerFinancial.com. They show that banks make between 400 and 1,300% on the money that you leave with them. That's insane. Because they control the money. That's why they do this. They're the ones in control. Okay. So does it make sense to be the one in control of your own money? Absolutely. And by the way, you can go back and look at like 20 years in history and see these numbers are very consistent. Okay. Now, to understand how to control your money, let's look at where money goes. What's the average pattern of spending in the average American household? So let's say for every dollar that you have that comes into your control, by the way, where does it go? Well, 20 cents of every dollar goes to automobiles, gas, tires, payments, things like that. 30 cents of every dollar goes to housing. 40 cents of every dollar goes to everything else, like travel, entertainment, food, clothing, things like that. Okay. So 90 cents right there. That's 90 cents. These are all added up. 90 cents of every dollar goes to somebody else. And only 10% stays with us. Savings, 401k, things like that. Okay. And by the way, I think before COVID, I think it was 5 to 6% was the actual savings rate. And I believe during COVID, it went up and then it's gone right back down again. So I wish people were saving 10%, but most people don't save 10%, by the way. So if you go talk to a traditional financial planner, what do they talk to you about? They talk to you about your savings. They don't talk to you about everything else. So what we're going to reverse that right now. We're going to start with the savings, okay, 10%. Now, how do we take the interest we're paying to other people and put it back into our savings? So let's look at the interest we're paying on all these things. So as I said, on automobiles, 20 cents goes to that. But of the 20 cents, 5 cents is actually interest. So what if we recapture that back into our policy or into our savings? Okay. Now let's look at housing. Now, if you have a mortgage of 30 cents going to the mortgage, 25 cents of that is actually interest, which is staggering, by the way, staggering. So what if you were able to recapture a bunch of that back into your savings? Okay. The last thing, everything else, so 40 cents, we estimate around 5% of that is interest, credit cards, things like that, for paying for things or like toys, all that. So what if we recapture that back into our savings? So that's really what we're talking about here. When you can control your money, you can control the interest and you can recapture that. So it's called recapturing. So understand that's what's going on in the average household. All right. So let's go through an example of how this works. So this is how you can get all the money back for every car you'll ever buy, drive, and own. All right, so let's look under the hood of a policy. So on the right-hand side over here, you're going to see what is called a policy illustration, okay? And so you're going to see things like deposits. So when we say deposits, what we're talking about are the premiums that you put into the policy. Now, the premium, we call them deposits because with like car insurance, as an example, when you make a premium payment, do you get anything back? Well, not unless you get into an accident, but no, you're not getting anything back. With infinite banking, when you put in a certain amount of money, you get something back. You can borrow back out of the policy. So we call it a deposit, okay? And you'll see those right over here, okay? Age does not really matter. Does it come into play with infinite banking? Absolutely. But I have people that are in their 60s, 50s, 20s, 1-year-old doing this thing. And I have people in their 80s also doing it because you can own policies on other people, by the way, okay? So so age doesn't really matter. There's lots of ways to use this. Death benefit. You're not going to hear us talk a lot about the death benefit because it is a benefit at the end of life. Okay. We want to look at the living benefits. Okay. So we'll talk about death benefit, but the living benefits are what we want to focus on. Okay. David says, what if you are uninsurable? Well, it depends on why you're uninsurable, but you can always insure somebody else that you have insurable interest on. Spouse, kid, business partner, siblings, parents, things like that. So a lot of our clients have policies on other people and you can do the exact same thing. You fund it, you own it, you run it, you use it. So yeah, so that's how you can do that. All right. So on this example, we're going to be putting in a deposit into a policy of $10,000 per year. Okay. Now, every time you put that in, you're going to get what's called cash value. Now, these numbers right here are what you can borrow back out. Now, these numbers are ultra conservative, meaning that in most cases, the amount that you get out of the policy that you can use is going to be quite a bit more. But once again, I want to be very conservative and show you how this can work on just a bare bones policy. Okay. So what's happening here is you put in $10,000, the cash value goes up. At the end of year 3, you're going to have around $25,000, a bit more of cash value that you can borrow out. So guess what you do? You go to your bank, you borrow out $25,000. Okay, so what does this look like? Okay, now you have a loan, but it's your loan, by the way. You choose how and when to pay it back. We'll get into that. But let's say you just want to structure it just like any other traditional car loan, 500 per month, 6,000 per year, pay yourself back. So what do the numbers look like? So you put in $70,000, and that's a premium deposit. You also put in $30,000 into the policy loan. So that's $100,000 you put into this policy over 7 years. But here's what you have to understand. You also had $25,000 of cash that you took out. Now we're going to use the example of buying a car, but you could have paid off debt. You could have paid for college. You could have invested the money for cash flow, all sorts of things. But we're going to stick with the car example on this one. Okay. So in reality, you put in $75,000, but of the 75, you've recaptured 91 cents of every dollar inside the policy as cash value that you control. So you've maintained control of 91% of that money. Now, usually it's going to be around 105%, but I'm once again being conservative. Okay. And you have the car. Now let's go look at years 8 through 12. So an optional thing that you can do with these policies is you do not have to fund it beyond year 7 if you don't want to. So in this example, we no longer put any deposits back into the policy. Now, I would recommend you do it because it grows faster, but let's say that you don't do that. Yet, guess what? In year 8, you go buy a second car. Maybe it's for your kid that just turned 16. Maybe give them your old car, you get a new car, whatever you want to do. Okay. So you go take $25,000 out and you do the same thing. You pay it back over time, $6,000 per year. So what are the numbers? So in years 8 through 12, you put in $30,000. But here's the catch. You took out $25,000 in cash. So really, you only put in $5,000 into the policy in those years. But here's the thing. It grew from year 7 to year 12 by $23,592. So once again, doing the math here, you put in $5,000, but it grew by $23,000 and change. Okay. So what does the overall picture look like? Okay. So you put in 75,000 years 1 through 7 and $5,000 in years 8 through 12. That's $80,000. Yet at the end of year 12, you have $91,000 of liquidity that you can use for whatever you want. Down payment on a house, investing in real estate, creating cash flow, whatever you want. And you have 2 cars that you own outright. So you own the 2 cars outright, and yet you have made money. Your money has grown throughout this time frame, and now you can go use it to do whatever you want. So that's how you can, basically buy cars and still make money and build your network. So hopefully that makes sense to everybody. We have a lot of people doing this, by the way, and we do map it out for you to show you how it exactly works. Okay, so there's 3 rules we talk about with infinite banking. So rule 1, rule 2, and rule 3. So rule 1 is to recapture your money. Okay, pay yourself first. So we're used to paying other people first, but in this example, we want to pay ourselves first. So we run our money through the policy. Rule number 2 is pay yourself back with interest. So pay back the loan with interest. Treat your banking system like you would any other traditional bank. Okay, be a responsible banker, we call it. And then 3 is recycle and recapture your money. So rule 3 is that when you have the money coming in, put it back through the policy, recycle it, recapture it, and put it back to work. So this works for a car. What else does it work for? So the other main thing that a lot of people, our clients use this for is debt recapture and debt payoff. Okay. Yeah. Lucy says that this process is the only way I've been able to pay myself first. Yep, exactly. Yeah. So we're going to use an example of how do you recapture and pay off debt? Because debt is one of the biggest wealth killers. And there's lots of ways to do this. And I've taught and mentored a lot of people on how to do this. And I'm actually going to be doing it myself here in a few months too. But for some business debt I have. So this is an example of a doctor. Now this doctor is a 45-year-old chiropractor, has $478,000 of debt. So they're a high income earner, and total payments of $5,777 per month, or almost 70 grand per year. So, and if they were to pay these debts off as traditionally scheduled, it would take 19 years. Okay. So this doctor is going to do a policy. And so when they did it, they're going to put in, let's see, how much are we going to do? So total debt is, okay, 25,000. Okay, so this doctor, so they're going to put in $25,000 into their policy per year. Now, if you're saying, well, Brian, where are they getting the 25,000? Now, keep in mind, this is a doctor, so just adjust the numbers for you. and he's going to do an annual premium of 25. Now, where is he getting that money from? So he had money going into retirement strategies, 401ks, savings, HSAs, things like that. And he said, wait a second, I'm going to divert the money from those buckets into infinite banking or my policy. So his cash flow didn't really change. What changed was where his money was going first. He realized that the 401k, he lost money, gone up and down, all that kind of stuff. So he stopped putting it in there and went in here. So once again, his cash flow did not change. Okay. Now he put in 25,000, and the cash value within the first 30 days was $14,863. Now that's a very conservative number. When we build these policies, it'd be closer to $20,000, by the way. So it'd be faster than this. But once again, we're being very conservative with these numbers. So what do? So we go to our bank, we take a loan out of 14,000 and we pay off the Discover card, the Lowe's card, and part of the Nordstrom's card. Okay. Now what happens to our monthly payments? Well, they go down. So they go down by $448 per month, and his total debt dropped. Now fast forward to year 2. So year 2, okay, $25,000 goes in once again. That's a second year premium deposit. The cash value goes up by $16,571, and we've been paying ourselves $448. So we've been capturing that $448 into a separate account. Okay. And that amount of money that has accumulated is $5,374. Okay. Now we have a total cash of $21,945 available to borrow back out. So we go ahead and we do that. Okay. Now what happens now? Nordstrom's card, Wells Fargo card, private loan goes away, and part of the BMW car loan goes away as well. All right. Total debt dropped down to $378, and your monthly premiums, or sorry, payments have dropped by $1,917. Okay. So they've gone down. So what does year 3 look like? Year 3, 25 goes in, cash value jumps up by 25,000 and change. The payments of 1,900 and change back to ourselves equals $23,000 and $4. Now the total cash we have available is $48,000 and change that we have available. So we take that money out and we pay off the BMW, West Marine, and part of the condo. Okay. Our monthly payments have dropped by $3,677. Okay. So you can see how this is very quick. This is at the beginning of year 3, by the way. Okay. Now I'm going to pause here for a second because I want to make sure you guys understand what we just did. So years 1, 2, and 3, $75,000 went in. Okay. We took out $55,000 though. Okay. So we took out $55,000 approximately. So how much is left in our policy? How much is left inside there working for us? Is it the delta between the 75 and the 55? No, because remember when we talked about how with infinite banking, you have uninterrupted compounding. What that means is that the full 75,000 is still inside the policy and still working for us. We're still earning dividends on the full amount that's inside the policy that earns dividends, even though we've borrowed against it. So that is incredible. So our money's growing for us. That's why the amount we can take out keeps going up and up and up. Okay, let's go to year 4. So year 4, 25 goes in, cash value goes up by 26,000. The payments of $3,600 back to ourselves equals 44,000 and change. Okay. Now the total cash we have available is $70,000 and change. So what do? Well, we wipe out a big chunk of the condo. Now, you have to understand what these condo and houses are. They're amortized loans. So amortized mortgages or loans, they don't change if you pay off the principal. The amount of the monthly does not change. So in year 5, year 4, the monthly payment doesn't change. Okay. So in year 5, same thing happens. 25 goes in, cash value goes up by 27,000, payments of $3,677 back to ourselves equals 44,000. Total cash is $71,225. Okay. So what happens? Wipe out the condo, wipe out a big chunk of the house. Okay. So now our debt has dropped to 91,000 and our monthly payments have been reduced to only $1,221. Okay. Now, what I want you to understand though here is that a lot of our clients, once they get to a certain point, realize how powerful this concept is, and they do a second policy. So your income goes up, you have more cash coming in, whatever, you might do a second policy. And so that's what this gentleman did. So here's what he did. So he opened up a second policy, but what he did is on the first policy, so you'll see it right here. On the first policy, he drops the premium from 25,000 down to 10,000. Okay. So in that year, cash value goes up by 13,000 and change. On the second policy, he goes in and puts in $25,000 into that one. Cash value is 14,863. Okay. All right. So total payments back to himself of the 4,556. So this number down here equals 54,000 and change. And the total cash he has is $82,633. So what does he do? He takes a loan out of 76,000 for the house, pays off the house, and now he's 100% debt free. Okay. Now, where is the loan though in the policy? So he has a balance on the policy loan. Okay. So what do? So in year 7, we take the cash flow of $5,777 and we put it back into our policy loan to pay off the policy loan. Now, at the end of year 7, he has no debt. He has 6 figures of cash value available that he now is going to put to work in investments and creating more cash flow in his life to build his wealth. So he went from 19 years to pay off all of his debts to paying it off in 7 years. And in year 8, he's now building wealth by acquiring assets. So that's how this can work. So it really can accelerate this. Now, if you're saying, oh, Brian, I have no idea what you just did or how to do any of that. So we have what is called the Debt Blaster software that actually maps out exactly what I just showed you. And it shows you monthly or annually how to do it, how to move the money, and to pay those debts off very quickly. So, but yeah, so we have what's called our implementation team. And so they're going to help you use the policy. So if you have any questions, you want to, change something, whatever, you hop on a call with them, they'll go through and how to do that. So there you go. But yeah, that's a fee there. It's a service that we provide. There's no fee to it. There's no cost, nothing like that. So keep that in mind. Yeah. All right. So let's look at the third section, which is the millionaire. So what if you have no bad debt? Because we have a lot of clients that don't have bad debt. We have a lot of clients that don't need a new car, as an example. So the question is, can I still benefit from privatized banking? Should I do this concept? The answer is an absolute yes, because when you have those things taken care of, that's where the fun begins, because now you start to build wealth and build that legacy. Okay. So what do a lot of people use infinite banking for outside of debt and a car, things like that? So active real estate investors, so wholesalers, flippers, buy and holds. I've done all that stuff before. I wish I'd known about infinite banking back when I was doing those. It would have been awesome. Commercial property, so apartments, mobile homes, private lending. So we have a private money club where people private lend to other investors. So that's another good way to do that. Kind of acting as the bank again, right? Business owners, a lot of business owners use this to take money off the table, do a key employee insurance, things like that. Very common. A line of credit for your business, things like that. Stocks and options traders. I do know quite a few that do this with in conjunction with infinite banking. Startups. So we've had some people that have started up businesses using their policy. And then equipment flipping as an example. So there's things like equipment flipping that we do that some people get involved with, where you can flip equipment for a profit. So there you go.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
All right, so what I want to do now, I want to kind of transition into showing you some examples of some policies and the numbers. So let's kind of see the real numbers of how this can work. So this is going to be an example of private lending, okay? Because a lot of our clients do private lending. So this is what's called the policy illustration or tabular detail, and you're going to see a couple different sections. So we tend to look at the right-hand section over here. This is the dividend section. And we're going to look at like the increase in cash value and net cash value. So in this policy, this person is putting in $50,000 per year. Just keep in mind, this is their numbers. Your numbers are your numbers. And they're also doing what is called a lump sum dump in, where they put in an additional large amount in at the beginning. So they're putting in $100,000 day one plus $50,000, whether they're doing it monthly or annually, up to them. Okay, so what does this look like? So I'm going to jump to year 8. So in year 8, so the cash value has increased by $66,722, right? The cash injection, how much they put in, was only $48,594. You see it right there. So what just happened? Well, because they have dividends coming in, the cash value is growing more than they're putting into it. So they have a 37% cash on cash return right now by year 8. So who here wants a 37% cash on cash return, right? We all want that. That's an awesome return on your money. But how do we make it even better? So let's say you're going to private lend. When you private lend, let's say it's 12% private money, okay? And let's say that when you borrow from the policy, you're going to be charged 5% interest. So the math, you're going to make a 44% cash on cash return with your money by doing it through the policy first. If you just private lent it out, it'd be 12%. But by doing the policy, It's 44%. Now, granted, yes, 8 years down the road, of course, that's what I'm looking down the road. But here's the thing. We did nothing different except where the money went first. So the question is, would you rather make 12% or 44%? If you want to make 44%, give me a one in the chat box. Give me a one or a Y or whatever. I'll make sure you guys are awake still. Yeah, heck yeah, there you go. Yes. Yeah, because I mean, it's pretty awesome. So we have people doing this, by the way. And people on the call right now here, I know some of them are private lending already as well, too, by the way. So yeah, so that's one of the examples of how to use it. Yeah, is that even a question? Yeah, exactly. Yeah. Yes, it really is not a question. Yeah. Okay. So why we can do this? Why you can do that is because of the uninterrupted compounding. Because no matter what you do with the money, whether you borrow it or not, it's still going to grow. And so here's how this works. So this is the power of uninterrupted compounding. So let's say you put in $50,000 lump sum and let's say around 6,000 per year premium deposits. Okay. So in year 2, the cash on cash return is 21%. Access to capital is 121. Year 10, the cash on cash is 54%. Access to capital is 154%. Year 20, cash on cash is 191%. Access to capital is 291%. So you can see how these things grow over time. And you might be saying, well, Brian, what if I'm 60 years old? I'm not looking at 20 years down the road. Well, guess what? If you put a large amount in up front, it jumpstarts the policy very quickly. But you can always do these on other people too. So like for me, I'm doing this on my kids because they're going to experience this benefit when they're, my age, as an example. So lots of ways to do this. So the Millionaire Method, how do you create that? So it's the same way you eat an elephant, right? One bite at a time. The man at the top of the mountain didn't just fall there, by the way. He actually climbed up the mountain. So why do I say that? It's because a lot of people look at the person at the top of the mountain, like the person that has reached their goal. Well, I want to be there too, but we keep walking around the mountain instead of climbing up the mountain. It takes time to climb the mountain. So that's why I just say the Millionaire Method is to get started, take that first step, get that ball rolling, and it will start to accumulate. So this machine works for debt, expenses, vacations, homes, everything else. So it works for a lot of things. I'm not going to go through this example in detail, but remember the doctor, if he paid back the homes as promised, he'd pay around $493,000. Okay. Now, if he had bought those homes using infinite banking as an example and earning 4%, he would own the homes outright and have $749,000 of net worth added. So this can really flip-flop things into your favor. Now, if you're saying, well, Brian, how do you invest in real estate? How do you invest in things? How do you know the returns, all that kind of stuff? We have software that does that. So we have what's called the gain projector, by the way, if you want to do software, or I'm sorry, real estate. So we will run the numbers for you. So you can see, okay, if I go do this, or if I go lend it over here or invest it over here, what is the return going to really look like? We'll map it out for you. So keep that in mind. There's no cost to us doing these things for you. It's just something that we do because honestly, we had to do it for ourselves because we use infinite banking in our own lives. And we had to create these things for ourselves, and now we just use them for our clients as well. All right. So now that you know how to do this, I believe that everybody should try to do this if possible, or at least talk to the people around you that could benefit from this, because gaining back control of our money away from Wall Street, away from the big banks, away from those that want to make money off of our money is the way that we can actually, I don't want to say completely fix our broken system, but it's a step in the right direction. I truly believe that. It's why a lot of us do what we do. So yeah, so teaching this to other people is probably one of the biggest things that we do advocate. Now, what I'm going to do right now, I'm going to put this into the chat box so that you guys can click it if you want. So the next step, by the way, and I have more slides, by the way, and we're not done yet, but the next step is to schedule a call with me and go through any questions you have, go through, what it would look like for infinite banking in your own life or for, people in your lives, and just go through what it would look like and answer any questions you have. And then additionally, I'm going to put my email address in here as well, so that if anybody wants those PDFs that I showed at the beginning, those books for free, just send me an email and I'll send you the link. Okay. All right, the next slide I want to share with you is just kind of one that I find funny. So for my life, most of my life, I was the guy at the bottom. I was working very hard for my money. It felt like I was a slave to money, right? And then transforming now into the guy on top where my money is working for me, because that's really the switch that we want to do, right? We want to switch that around so that we're actually not working for our money, but our money is working for us. And so that is that big switch that a lot of people want to make. And infinite banking is one of the ways that you can obviously do that. All right, so let's go through some other things that infinite banking can do. So we didn't talk about the death benefit, but we're going to talk about it. Okay, we're going to go through that. The loans. So I'm going to go through what the loans are, okay, and how they work, because they don't ever have to be repaid. Now, I'll explain that in a moment. The internal values, so the cash value grows tax-free. So this is not a tax strategy per se, but the money grows tax-free. As I said before, the policies are exempt from judgments, liens, things like that in most states. And then you can also use this to create tax-free retirement. So there's lots of things you can use this for, but let's talk about the generational wealth angle of infinite banking. So in this example, this person is putting in $20,000 per year for 5 years, and then she's dropping it down at year 6. And this is a 42-year-old female, okay? And they put in, it's 20,000 per year, so $100,000. Now, what you'll notice is that year 1, they put in $20,000, but the death benefit is $325,000. That's many, many, many times what they put into it. Now, God, we don't want anything to happen to anybody, of course, but what if something happened to her in year 1? That $20,000 is going to turn into $325,000 for the next generation or whomever she wants to have it. But let's go down the road. Year 5, you have now put in $100,000 into this policy, and the death benefit has grown to $483,000. Hey, take care, Kathleen. So the death benefit inside these things is always growing. The cash value is always growing. So you have an ever increasing generational wealth strategy, and it's tax-free. Okay. That's how this can work for the next generation. So if you can grasp what I just showed you right there, what's happening is this thing is growing no matter what. So this is why wealthy families do this on their family members. It's why they do it on their kids when they're born, because they know that over time, this is going to create a massive amount of wealth for that next generation. But they can also use this during their life for things like investing, building assets and cash flow, things like that. All right. So the policy loans, let's go through that really quickly. So policy loans are guaranteed. Essentially, just there's no credit, there's no check, there's no approval. Just ask and you shall receive the loan. It's guaranteed. You get it within a couple of days in most cases. They're private as well. So the loans are private. So I didn't talk about this, but when the doctor that was paying off his debts, when you move the debts into your policy loan, they come off your credit report, by the way, as well. So these are private loans. Excuse me. There's no maximum, there's no minimum payments. You are the one in control of those loans. So if you want to make a payment, go for it. If you don't want to make a payment this month, don't bother making a payment. It's up to you. You are in control. So miss a payment, nothing happens. So as an example, if you have a car loan with a car company and you miss a payment, what do? Repossess the car, right? So with this, nothing's going to happen. So that's why a lot of people like this, because once again, it puts the control into your hands. All right, another question I get quite a bit is how can I fund the bank? How can I fund my policy? Well, you can, first one is the premium deposit, like we showed. That can be monthly, can be quarterly, can be annual, and even semi-annually in some companies. Right? What's the minimum and maximum you can put in per month, as an example? So per month, 10 times your age per month is the minimum that you can do a policy for. And the maximum depends on the individual, but the maximum is typically going to be 15 to 25% of your gross income or gross revenue divided by 12 for monthly. So once again, minimum 10 times your age per month, maximum is around 15 to 25% of your gross income, that's before taxes, divided by 12 for monthly. So that's the range of what you can look at doing on these policies. Now, you can always do what is called the lump sum dumping. So I showed you that in some of those illustrations. So you can do like a 500 per month and then do like a 10, 15, 20, $30,000 lump sum dumping if you want. That gets you a lot of cash value very early on. So 50 to 90% goes to cash value. So typically when you do like a large lump sum dumping, 90% approximately goes to cash value, and you can borrow out within 30 days. Not 3 years, not 1 year, but 30 days. You can get money right back out into your hands and put it to work. Okay. And the next thing that people say, well, Brian, okay, so when do I get more out of the policy than I put into it? Depends on how you fund it. But because the dividends are coming in every year, uninterrupted compounding, essentially down the road, you can put in $1 and you can pull $3 back out right away. So the question always is, would you put in $1 to get $3 back out down the road? Absolutely. I do that all day long. And so these policies get very efficient, meaning that you put in 100,000, you can borrow 150. Okay, so you get more value out of it than you put into it over time. All right, policy example. So I want to show you what I'm just talking about, what I just said right there. So in this example, this is a 32-year-old female. She's putting in $10,000 annually per year and a $50,000 lump sum dump in. So at the end of the first year, we look at the non-guaranteed numbers. That's what the companies have paid every single year they've ever existed. That's the dividend side. So the increase in cash value at the end of the first year is $55,000. That's over 90% of what she's put into it. She has access to at the end of the first year. Now, it gets even better. In year 2, this person puts in a $10,000 lump sum annual premium. At the end of the year, the cash value has increased by $10,607. She's cash on cash positive already. But let's look at year 11. In year 11, she chooses to drop the premiums down to $3,000 and change. But guess what? The cash value still went up by $10,590. So you're putting in $3,000 and getting $10,000 back out that you can use. Pretty powerful, pretty cool that you can do that. And by the way, it just gets better and better and better every year. Okay. So here's a quote by Warren Buffett that it's not my favorite quote, to be honest. But it says, he says, if poor people would just do what rich people do, they wouldn't be poor anymore. My true opinion on that one is, if poor people had the knowledge of what the wealthy did and took action on that knowledge, they wouldn't be poor anymore. Because guess what? I mean, not everybody can do what the rich do, but if you have knowledge, man, you can take an action on that. So once again, guys, you can go to brian.beyourOwnbanker.com/TBCT on the Take Back Control Tuesday. And then that'll schedule a call directly with me, by the way. All right. So I get this question quite a bit. Someone says, well, Brian, why should I work with you? So I've been teaching infinite banking for actually about 8 or 9 years now. So I've been teaching it for quite some time. We have an entire team that works with you to set up infinite banking. So it's not like me and a couple people. We are a team of about over 40 people that help you do infinite banking. We are one of the, if not the largest producer of infinite banking here in the US, because we have a lot of referrals and a lot of repeat clients. I mean, heck, I've got people on here that I can see their names right now that are on these presentations pretty much every single week, just because they might learn one new thing about infinite banking. And so they're here all the time. So we have a lot of repeat clients. I currently have probably more than that now, but I have over 100 clients in underwriting at any one time. I have thousands of clients I've worked with that have policies. We do provide ongoing support and services. So a lot of other people that do infinite banking, they don't provide ongoing support. They don't provide the live streams that we do. Like on Wednesdays, we have our Wealth Wednesday webinar. We have our Ask Me Anything. We have WTF. We have all these live events we do where you can come in and ask questions of our entire team, or you can always call me up directly and get your questions answered. So we're very available, I guess I would say. And we do that at no cost to you. So there's no charge to you for working with us. Some people I do know, they will say, oh yeah, it's $5,000 to get you infinite banking. We don't do that. It's I don't think that's right, by the way, but yeah, there's no cost, no fees to you during that process. Another question I get quite a bit is IUL or VUL infinite banking? Straight answer is no, it's not. I have personal experience with VULs. I have one. My folder is sitting under somewhere. I've had VULs that were set up by people that didn't really understand infinite banking. And bottom line, it was horrible. It was a horrible policy. It did not perform at all. It was garbage. IULs also, by their very nature, indexed universal life. They're tied to the markets. We're trying to remove our money from the volatility of the markets and get consistency. We have a lot of videos that talk about IULs, but bottom line, IULs and term insurance, by the way, pay some of the highest commissions, whereas what we do with infinite banking reduces our commission by 70%. This is that reason right there. That reason right there is why a lot of financial planners and advisors will not do infinite banking, or will tell you that it's a scam, because they don't want to take a 70% cut in commission. They don't want to do that, right? And by the way, I have set up policies on financial advisors, other agents, and Dave Ramsey coaches. So I have set up policies for a lot of people because they hear us talk and they realize, oh, this is not what I thought it was. And so I have a financial advisor that was that saw an illustration I did for their client, and that client said, hey, they want to talk to you because they want to get a policy. Yeah. Yeah, Anthony. Yeah. Awesome. And we only do infinite banking, by the way. So we can do like annuities, but we don't unless somebody requests it. But we just do infinite banking, by the way. That's our main focus. And the reason why we only do infinite banking and why we don't do traditional insurance is because I would never sell traditional insurance to my family, my mom and dad, or my brother or sister. I would do infinite banking for them, but I would not sell traditional. I wouldn't do that in my own life, so I wouldn't do it in your life either. So we don't sell things to other people that we would not do ourselves. So this is kind of a funny thing. So in life, one of two things will happen. One, we're going to live. We're living right now, by the way. So do you feel that you'd be better off with or without infinite banking in your life? Obviously better off with it. We also know that we are going to die. So are we better off with or without infinite banking in that scenario? The answer is yes. Okay. And then kind of real quickly, how I kind of got into infinite banking. So a quick little kind of story here. So it's called The Tale of Two People. And so when I first was getting into finances or investing, I was the guy on the left. I don't need anything. I was like kind of the group one guy. And I was just doing what everybody else around me was doing. I didn't need anybody else. I heard about infinite banking, but I said, hey, you know what? I'm going to go have my buddy set this thing up for me. He set me up with a VUL and it was complete trash. And I realized that, you know what? Following that status quo and putting my head in the ground was not working for me. So I had to become the kind of the group two kind of guy. Whereas, you know what? When I learn about new things and I find that group that is making sense around that strategy, I dive in. So like with infinite banking, my mentor was one of Robert Kiyosaki's advisors. And when I realized what he was talking about and the knowledge he had, I dove in with him. I built a course on infinite banking that taught it. I wrote a book on it. So I really dove in. So just, you know, there is that group one guy. That was me beating my head against the wall, or group two, just kind of dive into this thing and let's see if we can solve your problem. So with infinite banking, really the focus is not the returns inside the policy. It's how we are solving your problems, how we are achieving your goals. That's really the focus here, and how infinite banking can do that for you. So really on the call, what we do is just, we want to see what questions you have, make sure we answer those, and then see how infinite banking is a fit for you. That's really the focus of those calls. And so I like to end the presentation on this quote by Will Rogers once again, because now it might make more sense. But the problem in America isn't so much what people don't know, it's what people think they know that just isn't so. So that's it right there. So anybody have any questions, anything like this? Oh yeah, Lucy, appreciate that. Yeah. Yeah, a lot of support, a lot of support. Yeah. And then Juan says, where are you located and where are the live meetings? I'm located in North Idaho, but we have team members in Colorado, California, Kentucky, Florida, New York, Carolinas, I think. We're kind of all over the place. And then the mastermind meeting we're doing later this year, I believe, is in Colorado, Denver, Colorado. And so we have a few live events we do a year. And so we just did one called Money Tank, which is for Private Money Club, which is our private lending platform that Chris runs. So we just had a event there. And then, oh gosh, where's Carson? So it's different team members. So Carson, oh man, where is he located? I'm blanking on right now. Yeah. Irvine. Okay, Dex. Yeah, he's in Irvine, California. I knew Dex would probably know where he's located. Lucy's in Hawaii. Yeah. It doesn't really matter where you're located or where we're located, because there's, we're 40 plus people, but yeah, we're not all in one central location. Yeah. Okay. So yeah. And then, like our, Chris's team is located in Buffalo, New York, by the way, as well. So, yeah. Let's see here. So any other questions anybody had for me before we call it a day? And yeah, there's no obligation on the call. There's no cost, nothing like that. So keep that in mind. All right, let me put in the someone's the link again. So here's the link to schedule a call, and then I'll put in my email again as well. So yeah, if you guys want to email me any questions you have, if you guys want to get the link for the PDFs, go ahead and just send me an email there. Christian, I'm not sure what that means. I do. It's not related to this though. Yeah. Oh, and then Lynn Doherty says, how much do I need to start my own bank? So, I mean, you can start with a monthly premium. I mean, it's just 10 times your age per month. So if you're 50 years old, 500 per month. If you're 35 years old, 350 per month. That's the minimum to get started. But, I can always go through that with you on the call. Yeah. Awesome. Thanks, Brad. Yeah, that's cool. Yeah. With is it with exam one? Probably with exam one, I bet. Yeah. Yep. Exam one. Yeah. Yeah, guys, there's no pressure to start this. And I'll be honest with you. I mean, this is not a fit for everybody. Infinite banking, we believe it's a fit for around 5 to 10% of the population can do it. Now, why do I say 5 or 10%? Because people will say, well, Brian, this sounds way too good to be true. Or, why aren't more people doing this? If this is so great, everybody would be doing it. 5 to 10% of the population can do this. So one, why do I say that? You have to be financially literate. You have to be financially responsible. Okay. Yeah. So you have to be responsible. Okay. That's the first thing. And that's called mindset. That's the knowledge right there, right? You have to be responsible with this. You have to qualify financially and medically, right? That's the other thing. You have to qualify for this. And half the population here in the US is on the government's payroll, meaning that they're on subsidies, right? They're lower class or income. And so they can't do this, to be honest. So right off the bat, half the population can't do this. And then a lot of people, just be honest, if you don't take care of the one body you have, which is your health, this isn't going to be a fit. This is a weird thing to say, but you walk through a Walmart versus you walk through a Whole Foods. The health is very different. And so that's the other reason why. And then just, some people just the mindset doesn't make sense to them. But yeah, that's why I say that, it's not too good to be true for most people. because they can't do it. So yeah. Yes, Dex. Yeah. If they have never heard of this, they don't think it exists. It's like, no, that doesn't make any sense. Why would that exist that way? Well, wealthy families have been doing this for, over 120 years. So yeah. Yeah, Lynn. Yeah. I mean, 10 times your age per month is the minimum. Yep. Cool, guys. All right. Well, with that, I'll let everybody go. I see some emails just came in from some people regarding the PDF. So I'll go ahead and get those out to you. But anything you guys need, anything you need from me, just email me, text me, call me. Some of you guys have my phone number. But look forward to hopping on some calls with the new people and seeing how this is a fit for you. But with that, love seeing all the familiar names and everybody. But take care, and we'll talk soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.